Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and I have one of my really favorite people to listen to, Julian Brigden. And Julian, I'll tell you, you've done about everything. I mean, you've done all this macro consulting, but if you go back, you've managed money, you've worked with hedge funds, you've worked with numerous companies on Wall Street. So you've got a good look at it, my friend, and you still look really young.
You did. I was when you were saying that, I was thinking, and how old does it make me sound? But thank you for that. Thank
Well,
you for that compliment.
yeah, you really do, and I mean that. But hey, I'm going to start off because I think I think you have some of the clearest looks at things of anybody that I know on the street. And so I wanted to start out with just some of your slides that you talk about, which I'll let you go, which starts out with everybody thinking Goldilocks is here. So I'll let you take off from there.
So yes, I mean, we went back and we looked at all the sort of tightening cycles since sort of 1960, and the reality is, ladies and gentlemen, statistically, Goldilocks outcomes aren't the base case. I mean, typically, we've had 12 tightening cycles since that 1960 period, and we've had 8 recessions. So at face value, at a bare minimum, this is a Goldilocks outcome is 1 in 3, and the base case should be some sort of recession. The other thing I think to note is, of those four quote unquote soft landings, all of them bar one occurred with significantly higher levels of unemployment, which means, Ted, that once you go through that sort of softness and the economy reaccelerates, you've got a pool of workers that you can use to hire from. And the only one that occurred from this level was actually a period that we've been focused on really for a very long time now, 1966-67, when the backdrop wasn't sort of overly unfamiliar to what we are experiencing now, in the sense that sort of one of global tension. It was obviously the beginning of the Vietnam War. We were spending a lot on defense. That keeps fiscal spending very high. The same thing, we had quite a lot of social programs under the sort of Johnson's Great Society spending. And so your unemployment was very, very low. The economy tries to reaccelerate after the Fed tightens. They let their foot off the gas a little too early. And actually, it wasn't really a soft landing. It kind of looked like a soft landing for 6 months in the bond market and for about 9 to 12 months in the real economy. And then what happened is, as growth reaccelerated, wages took off again and inflation came surging back.
I think
So
you
I
call that,
think
I think in your slide, you call that the slippery beast, and you highlight the 65 to 1969 piece in there. We can see it on the slide.
Yeah, absolutely. So this is why sort of achieving that soft landing is so incredibly difficult, because you are talking about ultimately trying to sort of slow employment growth down. I know the market singularly got in its head that it was only about inflation. All that mattered was inflation. Well, that may be the case if you've got 5% unemployment or 6% unemployment. But when you've got, 3 and change, some of the lowest levels of unemployment that we've seen in the post-war period, if you're a policymaker, even if, let's say, inflation disappears tomorrow, the sort of, fantasy dream of a lot of people, if nominal GDP stays quite high, and we're running very, very high levels of nominal GDP, Ted, so in other words, real growth plus inflation. So if inflation drops to 0, then real growth has to accelerate to fill that gap unless nominal GDP comes down. And then the issue is, where do you find the workers, right? So you've got these two risks. In a sense, it's kind of slippery as you're a policymaker. If you let your foot off the gas too early, like the Fed did in 66, 67, the risk is, particularly from these levels of low unemployment, that you don't kill inflationary pressures in the real economy and the economy takes off again and the pressures come back. Option number 2 is you hold rates too tight for too long, and then you lose momentum. And unemployment is really, and this is why it is so slippery, it is truly a momentum indicator. Now, Jeffrey Grunlack isn't a client, I can say that. But we put this chart out, and I think 2 weeks later, we saw a version of his, but he used the 26-month moving average on unemployment. We used the 27-month. I like to think mine was the original and is slightly better, but it's just really to illustrate a point, and that is that this is truly a momentum indicator. Otherwise, you couldn't run a moving average over it, right? And the point that it illustrates is once you lose momentum, it's incredibly hard to regain it. And unemployment doesn't just rise a little bit. It rises a lot because you lose a job that begets another job loss, another job loss. Ted doesn't go to the restaurant because he's just lost his job. Then, Julian loses his job in the restaurant, et cetera, et cetera. And so you can see that statistically, the base case is once you cross that 27-month moving average, which we did back in February, you've always, always, always had that recession, Ted, bar 66, 67. So that's why soft landings are so hard, because it's this balance between, holding rates too high for too long, lose momentum in the labor market, step off too early, and inflation comes back.
Well, and you have a great slide in there about that. When it remains too high, it undermines the inflation progress, which is, and it's interesting because you also talk about what Bostic said. You might mention that, and how you think that, hey, that's probably too late for that.
Yeah. So look, I think the Fed, my sort of summing up of the Fed is that they're as desperate as the market is to try and achieve what is a financial equivalent of sort of a triple sulco with a tuck and landing on your tippy toes, this sort of Goldilocks soft landing, Ted, right? And, I think I have a friend who's followed the Fed for nigh on 45 years, and he worked there for a while. And when I worked to one of the big hedge funds, and he's the favorite expression I have here is I've followed the Fed man and boy for over 45 years. They're always the most bullish at the top, and they've never caught a turn. Yep. And so when I sort of look at this, I think, they were very enthusiastic that they'd kind of nailed it at the end of last year. Things were moving in the right direction. And now they've got a little bit wary. And I think one of the things that I thought was very interesting was this comment from Bostic, who not typically a hawk, but has become much more hawkish recently. And he said, as my staff and I have talked to business decision makers in recent weeks, the theme we hear rings of expectant optimism. Despite business activity broadly moderating, firms are not distressed. Instead, many executives tell us they are on pause, ready to deploy assets and ramp up hiring when the time is right. I asked one gathering of business leaders if they were ready to pounce at the first hint of an interest rate cut, and the response was an overwhelming yes. So in other words, these animal spirits are alive and well. The Fed hasn't beaten them out of it.
Right.
And then he adds, if that scenario were to unfold on a large scale, it holds the potential to unleash a burst of new demand that could reverse the progress towards rebalancing supply and demand and would create upward pressure on prices. And this is exactly what happened in 1966, 67. Right?
And in your slide, you say he's too late.
I worry he is. And I show a slide here where I've got total employment, non-farm payroll, and then CapEx against the US equity market. And we've talked about this, I think, on the last discussion, Ted, and you certainly know that's a big theme that we follow, that we believe in this concept of what we refer to as hyper-financialization. So in a very sort of twisted way, if I were to ask you, what leads the financial markets in the US? Is it the real economy where it sets inflation, it sets profit margins? Does that lead the bond market and the equity market? And logic would dictate that you would say, well, yeah, that's how it should work. Not in the US, unfortunately. In the US, the equity market, through the behavior of CEOs who are only paid to be stewards of an equity price, sets how many people they hire, how much capex they do, and you can see this from this slide. And there's also other effects in wealth effects, which we could talk about in a second. But the point is when you look at this slide here, what you're seeing is, and this is why I said it's dangerous that Bostic could be too late. The rally in equities that the Fed triggered since November when they pivoted has already, if it is sustained, and that's the $64 trillion question, right? If it is sustained, almost certainly guarantees the pickup in demand that he is worried about.
So more inflation.
Yes.
Right.
And certainly more, let's say, a re-acceleration in growth, maybe a after this lull in employment, that employment starts to pick up again and wages come back, which is basically what drives service inflation.
And how do you feel like, and I think you feel this way, I'm asking a question, actually, that services inflation is what we're experiencing.
Yes. It really, well, I mean, I have a slide in here where I show core service inflation, core CPI, and core goods. And you can see, and they're all normalized back to sort of 2000. And what you notice is something very profound. Core goods inflation is basically zero, flat to slightly negative, up to COVID forever. And the unusual thing about COVID was that for once, manufacturers got an ability to shove up prices. Now, let's assume that that's dissipating, and I think to some degree it is. I think the stratification between different parts of the marketplace, certainly the bits that cater to the wealthy and to the rest of the economy. But broadly speaking, I think that's flat to slightly down again. But you can see that what sets inflation is really is that service inflation. And service inflation is a function of the labor market, and in particular wages. And wages, our work certainly suggests that wages are starting to look a little sticky at around sort of 4.5% to 5%. And there are signs as well of, if you look at, say, the ADP data, I'm not a huge fan of the headline index, but they do some interesting subcomponents. They show that job switchers who were making a lot more money were making 16% of the highs to switch jobs. That collapsed all the way to like 7 and change, but has now crept up back to 10. So this labor market may not be going in the direction that the Fed wants, which, JP finally today, we're doing this interview on the 16th, and later in the afternoon, he just had his speech, finally acknowledged it's not all moving in their direction quite as quickly as they would like.
Yeah, he was just on Bloomberg. I'm saying, and the byline below was, I think it said further progress has been slowed down. That's an interesting way to put it. But anyway, that was the comment. And because it's interesting, if people look at that slide you have on core goods inflation.
Yep.
I just bought a television, for example, for my wife's dad who's in assisted living, $190, 32-inch. I mean, it's gone down.
Right, exactly.
So many things are like that in goods, though.
It's interesting.
Yes. So having said that, and I think I heard you say this on an interview, which are always good, but I think you said something along the lines speaking about how that relates into the bond business, that you will. Am I right? Did I hear you say that you thought we'd be in a 2 or 3 decade bond bear market? Did you say that?
Yes.
I'm asking a question because I thought I heard you say something like
yes. We've been sort of in the structural bear market in fixed income for a number of reasons. Going back, Ted, if you want to, when we first had our first interview back at the very end of 2022, we asked the question, is the world coming to the end of the Great Moderation? And we said, the Great Moderation occurred sort of post, it started to some degree with Volcker killing inflation, and then we get the collapse of the Berlin Wall. We get this period of globalization. We reorientate defense spending back into the real economy, and that's obviously disinflationary and effective. And then you can go back and look at the interview. I'm sure Ted's got it on his website somewhere. I think it's on YouTube. But that creates a series of virtuous sort of cycles which depress bond yields and depress volatility around bond yields. So you create lower term risk premiums, et cetera, et cetera. And so we think that firmly is over. We're in a pseudo Cold War, and in many parts of the world, unfortunately, in a hot war environment. The defense spending is going to be egregiously high. I keep looking at Rheinmetall's stock price every day and kicking myself that I didn't buy it. But you're talking, if we go back into a Cold War period about defense spending where 4% of GDP globally was the norm, and I think the US was up in the sixes. Right. And we're in the threes at the moment. So you're talking that alone. But then there's this other factor, and that's this particular slide where we talk about demographics. And this is something that was a big topic of our conversation we had at our macro conference in September, and something that we're going to highlight to our investors again with a couple of interviews with people who talked at our conference. There is an assumption, Ted, in the world that is sort of we will build it and they will come kind of assumption. So in other words, we can spend all this money, we'll issue the debt, but there'll definitely be a buyer there. Yeah, sure, the rates might be a little bit more expensive to finance than it was in the past, but don't worry. And our supposition is that may not actually be the case, right? That we actually could be hitting an inflection point where the pool of global savings, absent more central bank QE, which may have to be the answer, or some sort of yield curve control, even here in the US, to sort of financially repress people and force them into buying bonds. You could get into this sort of situation where we may not find buyers for our debt, and then you start to see significant problems. And part of the problem is people are just retiring, and if that's what this green model shows you, it's a model where we base sort of dependents versus workers in the economies that buy US treasuries, and you look at the demographic trends in those places, and basically 2016 we hit the peak of workers to dependents, and now those dependents are rising as people retire. And what do they do in that period? They draw down on their savings. And where are their savings? They're in the bond market.
And you have to look at that graph closer. You've got a lot of good info on there about the demographic based model, the green portion, and then the uppercase, lowercase, and everything that happened. And it's interesting because you go on another slide to say that, and you're totally right and have been right on this, that government bonds are, they're acting horribly relative to, and I had to ask you this question about that graph. Why do you think it is then? I'm just curious, because we're with you on this. We've been saying for a long time now, you need to keep your maturities really short. By short, I mean less than 24 months now. I'm not talking about less than
No,
7
I think on our last interview you said 48, so you were short, and you said at the time, but
we
you can
do.
even lose money on that, right? Which is crazy.
Good. And so we've gotten shorter and shorter. But what I wanted to ask you was, if you look at some of the B of A studies last week, different things, people are driving into bond funds.
Yes.
Corporate bond funds too. And yet they're coming at them. In other words, you're losing money, so I want to give you more money.
Yeah. I think there's a lot of inertia in thinking, Ted. I think people, look, we've been in a bull market in fixed income for over 30 years now, right? I think there's a whole industry that is oriented, and I think we have to be cynical enough to take a step back and look at some of our peers in the space and say, look, I really, and this is not directed at you in any stretch of the imagination, but there is a lot of your industry that absolutely has no interest whatsoever in preserving wealth. All they want to do is accumulate assets to gain fees, right?
Right.
They don't take a proactive approach at all to risk management, and they go off the models, and the models tell them X. And so I think you have a whole industry in the wealth space that is designed to try and keep assets locked down. And one of the ways that you do that is to tell people, keep calm and carry on, for want of a better term, right? There's nothing to see here, just move along, right? If you think of the trillions of dollars that are locked up in custodial accounts, right, in fixed income, I mean, this is scandalous how this money is essentially being managed. But the horrible truth is that if we move into a world where this great moderation, which we talked about 2 years ago, is finally starting to flex its muscle and end, then managing that money is very, very hard. And there's very few of your peers who have the skill set, agility, and ability to do that.
Yeah, and that's one of the things we've talked about a lot. If you look at the people in the industry the last 15 years, they really don't know how to manage money direct on. In other words, they're buying ETFs and they roll out the 60/40. And I've said all along that if we get what we think and what you're thinking too in the next 20 years, you're probably going to have a lot of people leave the business.
Yeah. Yeah.
And they couldn't adjust. Now, you do have a good slide in there on just bubbles in general, and obviously we've been in one, and you've got you compare NVIDIA, which everybody talks about, to Cisco, but it's an interesting comparison.
Yeah, look, I mean, this is just a bit of chart fun, right? I mean, to some degree, right? Nothing's quite the same, ever the same, but we do have what we refer to as a classic bubble chart, and we've gone back and looked at all the charts, so in 1929, the Nikkei, the Nasdaq in 2000, the Saudi market in, I think it was like 2016, single stocks like 3D printer people when they were on a tear, roughly around the same time. And they have these quite remarkable elements in that they share. And so, I looked at Cisco in 2000 because I think, a bit like NVIDIA, it's a hardware company. It's not a software company. It's a hardware company. And I do remember the euphoria around Cisco in 2000. And I do remember going and having some physiotherapy because I twisted my ankle at the time. And my physiotherapist, who was in his mid-30s, was going to retire because he owned a lot of Cisco stock and he'd extrapolated the growth rates. And in 2 years, he was going to be able to retire at 35. And I said, but the world can't work like that, right? Everyone who owns can't retire, right? And then cash it in and live off those proceeds. It doesn't work anyway. But when you look at sort of Cisco, you get these patterns where these very long extended periods where early adopters are kind of looking at stuff, and then it gets exciting, and you kind of get this sort of 45-degree line. You typically get this sort of bear trap before the thing breaks out and goes sort of parabolic. You get this. And from this consolidation period, which we show here, and then you push up in this parabolic move till you kind of hit what we call the pause. And it's the pause that usually refreshes. Now, I don't want to be too clever and say, we're going to hit exactly 1100, but you could see the similarities here. Now, a couple of things that I would say, people will say, oh, yes, but, this isn't Cisco, because Cisco's PE at the highs of 2000 was 400 and NVIDIA's only 70. But Microsoft's and Intel's were also around 70, and their stocks still dropped 80%.
No, it happened. There were a number of that top 15 or 20 like that. And it's interesting. And I think you having managed money, you appreciate this. The thing about managing money right now is that with everything you said, you have a slide here that really bears it out, is that the momentum is still there, even though things are expensive, but the momentum is still there.
Yes. And that I think is, look, I do truly think that there is, in the US, this kind of reflexive cycle going on. And for those of you who don't know, reflexivity is a term that Soros came up with, and it basically describes a situation where when you purchase an asset, the actual purchase of the asset underpins the fundamentals that drive and support that asset. So it becomes a truly virtuous cycle, but things can be reflexive on the way up and reflexive on the way down. And I do think that to some degree, what we are seeing, and this is not the first time that we saw it going into the dot-com bubble, We saw it going into the GFC, although the money was going into different things. The US tends to get caught in these cycles because it is the reserve currency, and money naturally kind of flows in here. And as a reserve currency, we also are obliged to run large current account deficits to provide those dollars to the rest of the world. And so people have pools of dollars which they try and do something. So let me describe how it kind of works. So if you start with sort of 09, coming out of the recession, European rates were very low. US rates start to rise, particularly corporate debt's yielding pretty well. So people start to buy corporate debt. American companies take that debt, they start to buy back stock. US stocks start to outperform. As US stocks start to outperform, the Fed is quicker to raise rates. The dollar starts to outperform. Johnny Foreigner looks around and goes, oh, I can get really good money on the dollar's going up, and I can get really good money in US corporate yield. Let me go and buy some of that. And as you do this and stocks go up and yields go up, as yields stay where they are and money flows into the US, the economy starts to boom. The current account deficit starts to rise. That requires even more overseas funding and more money comes in. And you can create this kind of virtuous cycle, Ted, and it's reflexive, so it's self-reinforcing, so it's very powerful, but it is inherently unstable because it relies upon an ongoing strong US economy. If the economy goes into recession, you can see in these red bars that I put on there when you've had recessions, then the current account deficit will shrink and the money will go home, right? Mr. and Mrs. Schmidt in Germany will take their money home. Likewise, if the dollar falls, they'll start to lose money in their own currency, so the money will go home. And then thirdly, if we find out that the US equity market really is a bubble, and that bubble bursts for whatever reason, the money will, which is the case in 2000, the money will go home.
You know, it's interesting too, because on that graph you have, if you go back, the last sort of major spot there was 15 or 16 years ago. We had that minor one in 20, but
yeah,
everything's, kept on going, what you're talking about on the cycle. And it's interesting because I haven't mentioned this slide, but you have a great slide on travel plan, how people in the stock market, when all their prices are up and everything, they're really excited. So they do things like travel overseas.
Yeah. So I know we were just mentioning you subscribe to Jim Bianco, and Jim does some great work. And he picked up on this one slide, which showed it was the conference board question, are you going to take a holiday kind of abroad, right? And this is the definition of discretionary spending is an overseas travel. And I think it hit, basically all-time highs at 22% of Americans. So if that stays like this, you better book your trip quickly because there's going to be no hotels. But in the Amalfi Coast. But the way that my dyslexic brain works, Ted, I looked at that slide of the conference board question and I said, oh, that's the S&P. And I overlaid the S&P, and it is. And what is this meant to tell you? That the US is being driven not only by that hyper-financialization from the behavior of corporate CEOs, but the hyper-financialization from the wealth effect and what that's doing to spending, right? As stocks have risen, so the percentage of Americans who intend to take that trip abroad has risen, because we know that it really is the top echelons that do it. It's a very, very expensive thing to do.
Well, I know, and you mentioned, following that up, that, you've started looking for bargains elsewhere, particularly in Japan. And I wanted to, as kind of a fade into the next slide, those two slides, you also talk about precious metals. I thought you might discuss where you're looking besides the U.S. here.
Yeah, so I think it's quite remarkable, actually, when you look at precious metals, how precious metals have actually kept reasonably good pace for the last couple of years with the S&P, right? I mean, if you look at silver, really, and this is silver, not even gold, right? 2018 is really, the S&P hasn't outperformed silver. So we're kind of looking at this. as a place that I certainly have got a lot of my own personal money in stuff like this. I think it covers a myriad of potential risks here. As I said, at some point the Fed is forced to cut rates, even if inflation really isn't truly under control, because of debt problems, because of regional banking problems, potentially again, Ted, all those sorts of things. So I like it from that perspective. I like it if when they do that, the dollar starts to fall. I'm a little wary right here, right now, because as you'll look at that slide, you'll see when last time silver massively outperformed was really kind of 2000 into 2009, 8, 9. And you get two phases, and I've called them nasty and nice. And just to keep it simple, so what's a nasty correction in the ratio? The nasty correction in the ratio is stocks fall a lot and silver falls a little, but it still falls. So on an absolute basis, it's still a painful trade, right? It could go from 28 to 20, but stocks could go down 50%, right? So the ratio would come in, but it would be a bad. And then you get the nice one where silver just outperforms and stocks maybe go sideways or slightly up, but and that really takes the Fed easing and the dollar falling. But we're not kind of there yet, so we're wary about that one, and we're watching it very closely. What's the nature of the correction? And then elsewhere, when we look around, we write very extensively about Japan. I have an old colleague of mine from my days when I worked on the policy consultancy side, and Jeff is a beyond fluent Japanese speaker and been in the market even longer than I have. And he writes our Japan update, and there's very few people putting anything out about Japan. But we think we're arguably in a secular bull market in Japan that could be equivalent to the 60s into early 70s, where really Japan massively outperformed. And we think there's a series of events there that are positive. The first one is the geopolitics. We think there's a lot of Japan's going to become a hub for high-tech production in the Western sphere, in the US kind of side of the world, if for want of a better term. Secondly, there's a lot more re-onshoring from China back to Japan by Japanese companies. There's the whole weak yen, which is encouraging tourism. There's all sorts of positive kind of effects. If they can get, at least initially, a virtuous cycle where rates start to go up as well, that's going to help the banking system. Lending to the manufacturing economies will help the banking system. So we have a chart here, which is, once again, it's a bit like that sort of chart fun that I showed earlier, where if you look at Topex banks in dollars, they look as though they're breaking above what has been resistance for the last 25 years. So, and when you see how far these things could go, they could easily double, and that wouldn't take that much, Ted. And I think that's better returns than you're probably going to get in the NASDAQ from here.
It's interesting too, Julian, that if you look at sort of how I'll use this broadly, Wall Street is situated right now. They haven't moved toward the metals. They haven't moved toward Japan significantly. They're still in the old 60-40 run, thinking that's going to be the way to go. And so it looks like there's a huge, huge disconnect about what people really need to do the next 5 to 10 years with what they're actually doing. How do you see that?
Yeah, I mean, there's a couple of technical guys that I follow, and we're going to put something out on it for clients because I just think it's intriguing. And it's on the precious metals, and basically I'm saying, you've got to think outside the box here. And when you do that, I've got sort of fundamental reasons why I think these things could go significantly higher. I'm not sure we're necessarily going to like the world if we're right, but that's our job, is to try and help preserve wealth in whatever world we're thrown into. But they're talking about a run up in silver now that runs us up to somewhere between 40 and low 50s, then a very sharp correction in some sort of broad risk-off event, Ted, right, which drags down everything. And that could come post the election. But then a move, let's say from the mid-20s or low 20s, that runs up as high as, and this is silver, 150 to $250.
Interesting. Well, I'm assuming gold would be not far behind, but not as much.
I think gold would be doing pretty well.
Silver
Gold would be doing pretty well too.
Don't you think silver, though, in the bull markets, once it gets going, it's about 3 to 1 on gold?
Yeah, it is. Yeah, and look, it's the high beta one, and can really be daring, Ted, and do junior silver miners or silver miners, right?
Yeah, you'd have the micro market of metals.
Yes. Yeah, and look, I mean, I think the big thing, and as you raise an interesting point, there's the inertia that's still in fixed income on the assumption that we're going back to the bull market of the last 30 years, which you and I think is essentially dead. You try to take 1% out of that treasury market and stick it in gold, and you think gold has gone up a lot so far? Well, certainly silver, right? I mean, these things just go parabolic.
Yeah. Let me ask you this one last question, and that is, if we were sitting in a living room and talking with maybe 4 or 5 investors, individual investors, in a broad sense, what would you say to those individual investors that would be good advice for them the next 5 years?
So I think you have to go back to stock picking. So you have to give good stock pickers. You certainly want to be invested in the equity market, less heavily, I think, in the US than you have been. I think that's been a great place to be. And I'm not necessarily a believer just in, the tech solves the issue, right? I think there are great tech companies elsewhere in the world that have done an amazing job at delivering. For example, I like to wind people up on Twitter a little bit, or X, or whatever it's called. And so I've been tweeting about Tesla. And one of the things that I pointed out was Xiaomi coming out with this new car, which Apple has failed to do, right? This is a tech company, right? It's exactly like Apple. They've also come out with the full home integration, which Apple has failed to do. And Tesla doesn't have all the home integration. And this is a car that integrates with your lighting system at home and your TV set and everything. And I just look at these companies in the rest of the world, and they're incredibly cheap relative to US tech. So I don't think US tech, I think you need a broad balance to go back to owning at least 35% of your stocks overseas, which is what you were told that you should own. But you should own stocks. I think you need to own commodities, gold and silver, I think, and gold in particular, as a alternative to fixed income. Fixed income is there, fine. But I think, like you, Ted, at this point, the balance that I have, I don't take any duration risk there. I don't want to take any duration risk there. And the other thing that I think you need to be quite careful of when it comes to wealth preservation, and this is something that I don't think, and it's not easy for Americans to do, is I think you need to be cognizant of your geographical exposure. Because if you have, businesses which generate a lot of money overseas, I'd be tempted to keep some of that money overseas. Don't bring it automatically back. If you think you're going to be the person 20 years from now who wants to be retiring to Spain or Portugal or Greece, I would be putting cash over there. And the reason that I say that is, unfortunately, I think if we are going back to a world which looks like the 1960s or the 1970s, we need to be prepared mentally for a world with those degrees of regulation. And in those old days, you couldn't take cash in large quantities and move overseas, right? There were capital controls and exchange controls. And so I think, for older retirees with plenty of cash, as I said, if you think you're going to go and spend time abroad or you want to move abroad, you've got to be planning that kind of now.
Yeah. Well, I'll wind it up on this, and I'd have to say, I always love your comments, by the way, on Tesla. It's like we now have the morning after a big party, and you're really hungover, but you're looking and say, I shouldn't have done that, so to speak. And then the second part is, and I believe I'm quoting you correctly on this, and I happen to agree with you, that Apple is a one-trick pony.
Yeah.
I think that was your comment. And if you look at it, you've been right on the money, because nothing has really come forward that's a lot different, really.
No.
I mean, I told somebody in the meeting today, actually, I said, look, you can't change the font size and expect me to buy another phone.
Yeah,
right?
exactly.
So,
I mean, although you and I probably are increasing the font size every other year, but that's beside
probably
the
are.
point.
Yeah. Well, listen, we put up a number of times here how to get in touch with you. I'd recommend people to really consider your service. I think you do some wonderful work, and it's some of the best I've seen and know of on the street. So, Julian, we appreciate you coming on, and hopefully next year we can have you back if you would.
Yeah, I'd love it. I'd love it, Ted. That would be great. That would be great, sir.
All right. Well, Lil, thanks so much. We'll hope to see you next year.
Cheers.
You bet. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.